Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, our investment analyst. So happy to have you join us for this week of December 14th as we talk about things that we found important from our investment meeting. We're going to talk about inflation, not just in the US, but globally. We're going to take a look at some bond changes that we've made in the portfolio as a reaction to where the market has adjusted. And then Zach's going to clean up here with labor market and talk about some gains that we've seen there. So let's just start off with global inflation. I think it's just an important reminder that as we came out of the pandemic, it wasn't just the United States, but basically the entire planet kind of swelled up with inflationary pressures at the same time. And then we peaked and have been declining ever since. And the key measure here in Europe, focusing here on their consumer price index, has come all the way down close to 2%, which is also their inflation target. So almost meeting their objective. And as we see these levels reached around the globe, it's expected that we'd begin to see them back off the pedal on interest rate, certainly interest rate increases, but also perhaps beginning to cut them. That'll be one of the absolute most important things going into 2024. That is in Europe, and we're not quite to target, but not too far behind them as we're descending down somewhere in the threes and then hopefully continuing like they are into the two. So that's inflation, which has been one of the drivers for the changes in interest rates. We'll look here on the next chart as a chart of the 10-year U.S. Treasury yield. It's been as exciting as ever. 2021, as we've hit so many times, was just such a record-breaking year in terms of bond declines. And through most of this year, it was following up with another devastating blow on the bond side, but there's been quite a bit of relief. So keep in mind here, so this is a picture of the yield. So through, let's call it the bottom there in the spring and to the peak of the fall, that's interest rates moving up near 5% at one point in time in the fall before backing down, not all the way to 4, but approaching it before it's elevated here. So as we move through this cycle, as interest rates adjust, we adjust the positions in our bond portfolio, something you guys are well acquainted with now. As interest rates rose to 5%, we began to get even more and more aggressive with our bond purchases, something that we were really, it was a flip for us after having been so defensive over most of all of 2021 and then most of 2022, all of 22 and most of 23 as well. But began to back off of that and allow ourselves to purchase some bonds at 5. But after we see the yields drop so quickly now, then we are forced to react. So that's just another reminder of why you see, especially for those of you that get paper confirmations, why so much of that comes through the mail. As the bond market changes, so does our portfolio. But one reason we wanted to back off of that just a little bit here as we go into the middle part of December, we had an employment report last Friday, and now we have the Federal Reserve coming back with their last meeting of the year just ahead of us. And so we just want to be a little bit more cautious because these last several months have been nothing but the market just pricing in lower and lower interest rates. And if that does anything to remind us that they're just not ready to cut yet, it could shock things. So for now, the trend is down, but we want to be a little bit less aggressive than we had been. So that's my side, Zach. If you would fill us in then on what we didn't see it in the labor market, I'll let you take it from there.
Yeah, thanks, Adam. Well, for the past year and a half or so, dating back to the middle of 2021, we've had negative real wage growth. And all that means is that while wages were rising, they were outpaced by high inflation, as Adam mentioned earlier. And the net result was negative to the U.S. consumer. In terms of how that played out, particularly with the lower end consumer, savings dwindled as consumers had to draw on the money that they had saved up in order to support lifestyle. And we actually saw an uptick in a pretty steady uptick in 401k hardship distribution requests, meaning that people were not only pulling on savings accounts, but they were dipping into retirement funds in order to support themselves as inflation outpaced wage growth. However, the bottom chart there, you can see the little green lines that have popped up here recently. Real wage growth has actually ticked positive as inflation's cooled off. The Net effect there, in theory, is that the consumer should not have to draw on savings as much. They'll experience the lifestyle benefit, so to speak, of having wage growth, of seeing their wages increase. And that has the potential to add some strength to the overall consumer, improving consumer demand, and in turn could draw out this particular part of the economic cycle a little bit longer. Now, the extent to which this impacts the current economic cycle remains to be seen, but real wage growth turning positive for the first time since 2021, certainly a good thing for the U.S. consumer.
Yeah, absolutely, absolutely, and good job, Zach. I appreciate you jumping on here and filling in and covering this, and I appreciate all of you jumping on and giving us a few minutes of your time, as always. We'd like to leave you here with a reminder that if you could be of service in any way, please don't hesitate to give us a call, 800-928-4001, or just scan the QR code and book it electronically. Either way, we appreciate you and hope you have a great weekend.